Hello, I'm Karen Ashley, Head of Marketing for Refinitiv America. Welcome to today's webinar, The Psychology of Financial Markets. The U.S. is averaging 59,000 new COVID cases daily, and that's the most since the beginning of August. Last week, 886,000 unemployment claims were made by Americans, and that was up 77,000 from the prior week. Today, Senator Mitch McConnell announced that there will be a delay in the CARES Act, in the Part 2 of the CARES Act, until after the voting on it, until after the elections. Across the nation and across the world, fear and anxiety is heightened. You may keep a cool head, dispassionately analyzing corporate results, economic data, and emerging trends to pick up investments. But that doesn't mean that everyone else is just as reasonable. If others act irrationally, markets can be distorted and your returns eroded. Those emotions cause investors to misjudge the impact of events in systematic ways. Dr. Richard Peterson and his team of researchers are in the business of identifying these patterns and providing data to help investors gain an edge. We're going to hear from him about his research and the overlay of COVID and the elections. Let's keep the session with him interactive by putting your answers, your questions in the Q&A box. And there will be a couple of polls. I encourage you to get involved in those. At the end, we will make time for your questions, and we will also send you the slides from today's presentation. So I'm going to get out of the way and pass the presenter rights over to Dr. Richard Peterson. Thank you.
Thanks, Karen. All right, so today's topic is obviously timely and can be somewhat controversial, and certainly there's a lot of stress going around, as Karen mentioned. So why is this, and what is it that's happening? I think I get this question a lot. People trying to understand the dynamics of our current situation, our political environment, our response to coronavirus. And I think it goes back to what we see embodied in this quote by Robert Shiller, that narratives are really the key to understanding behavior, whether it's economic behavior or social behavior. What are the major narratives that are being not only pushed, but infecting us virally? As, of course, we can see with diseases, we can see this with memes or information. And the key to understanding how markets move is often to understand what is the narrative that the majority of money is focused on, and where is that narrative going? And we'll talk about this in the context of the elections and obviously coronavirus as well. Before we do that, we'd like to know a bit about your thoughts on the election and especially the outcome. So if Biden became president through 2021, what do you think would happen with the U.S. stock market? Would there be a rally? Would there be sideways volatility? Or would it slide lower over the year? So from January to December 2021, what do you think would happen with the U.S. stock market? Now, please enter your polling response there, and then I will click submit, and we can move forward. All right, so I'm going to submit this. Let's see what we got. Hopefully we had enough time. Actually, that was submitting my response. Do we get responses on this, Karen, live? There they are. Thank you very much. All right, so as you can see, there's a lot of uncertainty. There is about a quarter more saying rally, a quarter more saying slide lower, and the majority, half, saying sideways volatility. So there's uncertainty. We don't know where things are going. And that brings me to this slide on uncertainty. So uncertainty is an interesting phenomenon because it often provokes a projection of how we're already feeling into that uncertainty. If we're worried, we project more fear and negativity onto an environment of uncertainty. If we're very positive and excited, we often project the positive outcome onto that environment where there's uncertainty. We see this, for example, with IPOs during the dot-com boom. If they didn't have revenue, they were priced higher than if they actually had revenue. So uncertainty is really a function of what we're feeling. And so we decided to go back and look at prior elections. We looked at the level of media uncertainty in the US, which is this yellow line, on average for every election from 2000, so 2000, 2004, 2008, et cetera, up through today. We averaged the level of uncertainty expressed in the media, and you can see from 90 days before, the uncertainty rises dramatically and then peaks about 2 weeks to 3 weeks before the election. Now, down below, you see lines that represent each level of uncertainty before each election over those periods. And to the right, you can see the year. I don't know if you can see my mouse pointer, but the lower right corner, there is the year. The red line here is 2020. And the red line shows that we are actually at peak uncertainty more this year than any other year. So we have significant uncertainty now, even more than this average we see here. Now, the dotted white line in the top plot is the average S&P 500 return around every U.S. presidential election since 1928. And so you can see an interesting pattern here. Generally, markets stay sideways until about 2 weeks before the election, and then they take off in a rally. Now, this is likely because the uncertainty is tamping down the willingness to take a risk. People want to know what the outcome is. And then about 2 weeks before the election, as you can see in our media now, there is a projected winner. And so then the markets start to adjust for that winner. And in the relief of the uncertainty, in what's called in psychology, the uncertainty collapse, then we see that people start taking a risk again, and we get a rally. So this is quite an interesting phenomenon, we think, and we hope you think so as well. And I'll show you some additional charts like this where we're basing our analysis on media sentiment. Now, obviously, uncertainty isn't really positive or negative. It could, as I said, it can go either way. But the key to understanding markets is to know that they are multidimensional, that the narrative that's being transmitted can be, in this case of U.S. elections, one of uncertainty, until reporters and others start to jump the gun and say, you know, I think it's pretty clear who's going to win. It's this person. So, for example, if it's Biden, we should focus on renewable energy and solar stocks. So you start to get a new narrative that forms. So we'll talk a bit about how we do natural language processing to pull out these types of tones, like uncertainty or narratives. Then we'll look at some price patterns and how this type of data reinforces findings in that field of behavioral finance, and then some predictions, and of course, social narratives. But before we jump into that, before I jump into talking about sentiment data, I'm curious if you, the audience, use sentiment data in your own research. So there's different ways of using this. For example, we can use quantitative data, like ingesting a commercial feed and then crunching it and generating predictions. Or there's qualitative observations, for example, looking at the commitment of traders or put-call ratios numbers, or simply looking at a screen with a social media sentiment bar on it. That's what would be the second option, qualitative observations. Or, of course, no, you don't use it, or you're not even investing it, or it's not applicable to you for some reason. So please respond there to one of those bullets and submit your response. And then I will go forward now. Okay, so majority of you actually use quantitative data. That's fantastic. Okay, and then quite a few as well, qualitative observations. About 20% don't use it, which is understandable. So this type of data, of course, is not discussed in your Masters of Financial Engineering, typically. Lately it is, but historically it hasn't been. And so most people in the financial industry have had no exposure to data based on the information flow. Yet at the same time, in financial theory, we learn that information is what moves markets. Information determines pricing. So we don't receive instruction in how to use this data or what this data is, and yet we're told that information is the most important thing. Now, fortunately, that's changing, but it is changing slowly. It's really a generational change, because underlying this is, while it's rational on the surface to use sentiment data, underlying this, though, are psychological tones like uncertainty. And once we start delving into the realm of psychology, things become a bit more, the science becomes a bit more fuzzy, we should say. Now, of course, it's fuzzy in finance as well. But in psychology, it's also intimidatingly fuzzy with more jargon at times. So let's talk about an overview of how we do natural language processing. We ourselves have been doing this since 2004, so over 16 years. When we've been looking at how to pull out tones and sentiments from information flow, as well as themes. We started a hedge fund in 2008, which was called a MarketPsych long-short fund. And you can see that online. It did quite well relatively over its lifespan from 2008 to 2010. It beat the S&P by 24% net of fees and had 1/3 of the volatility. Of course, the S&P didn't do well, but also beat its benchmarks, and it was one of the top hedge funds. But we couldn't raise money because of the financial crisis and the difficulty with liquidity back then. We partnered with Refinitiv in 2011, at which point we realized that this type of data was the most important thing. We wanted to keep our technical operation going and thriving. So we partnered with Refinitiv and released sentiment data. And then last year, we partnered with them to release predictive data. So it's one thing to produce data. It's one thing to trade on the data, but it's another thing to actually create a model and say, this is, we believe, predictive and robust over time on thousands of assets. And so that's what we've done as of last year. And we'll update you on the performance there as well. So how do we do this? Well, we take news flow, like this article on Luckin Coffee. We crawl it, we obtain it and pull it into our feeds, then we analyze it. We pull out entities like China, geolocations like China, entities like Luckin Coffee, bearish tone in there, associated with terms like plummet, and terms related to legal issues like an investigation of the management. And then these are reflected on some of our indexes. So every article that comes through is then broken down into sentiments and then aggregated into time series indexes. And these are things, of course, like sentiment, so the net positive and negative bullishness or bearishness of a phrase or an article. Then we also have other indexes that are more granular, like management trust. So if there's an investigation into management, that generally dents trust in management. And so you'd have a negative pressure on that index. It would have a negative score, and it would drop for that entity, Luckin Coffee. Now, we do this for over 140 emotional and thematic indexes. At least that's what we publish. We actually do it for over 4,000 internally, because there are, of course, many topics and themes that we can track. And we track some of these complex themes like earnings forecasts. It turns out you can pull out the earnings forecast from the media just using natural language processing. So we pull out earnings forecasts and look at whether where that is relative to the consensus, the consensus according to the media, and then calculate an index there as well, based all on the information flow. We do this from over 2,000 global news sources and 800 financial social media sites. From 1998 to the present. So we have daily, hourly, and minutely data for over 20 years and over 15,000 assets, including companies, countries, stock indexes, sovereign bonds, etc., even cryptocurrencies. And so because we've got so much data from thousands of sources, we're able to generalize this with quantitative research and try to understand what are the patterns in how information impacts assets across all assets or across thousands of stocks, for example, in different countries. And so I'll show you some of the common patterns that we see coming out of this data, many of which are at least anecdotally confirmed in academic research. First, though, is an overview of the information cycle. So how does news and information hit a market? Well, I'll use the COVID sell-off and rally as a template here. In general, it's like a sine wave. So you may have market prices doing well. That's often an uptrend due to good news coming out, sort of dribbling into the market. And then it's said that prices react and they underreact. So they take time to adjust to good news. Good news isn't priced immediately. And so that creates an uptrend. Then we have a negative event, in this case, COVID in the spring. And markets start to go risk off. People initially underreact to that negative event because they want the party to continue. So they say, well, as Jamie Dimon said, or not, Chuck Prince said during the financial crisis, we'll keep dancing until someone takes away the punch bowl, to paraphrase him. So markets keep going and risk is continued to be indulged in until something bad happens and others start to pay attention. So the markets start to slide. And the question then is, what is this bad news? And there's uncertainty around the bad news. Markets slide and we start to understand it. Now, during this process, like with COVID, I was on a few email trails with large investors, and they were trying to understand what would lead to the bottom. How do we time the bottom here? Because of course, if you can time the bottom, you can make quite good money. We all know what's happening. We know this cycle. We don't want to be caught on the wrong side of it, and we definitely want to be able to catch the bottom. And so the consensus narrative was, it's not the number of cases that should start going down. It's actually the acceleration of the growth that needs to decline. I mean, the second derivative. So if cases are growing at 20% a day, that's a problem. But if the moving average of cases starts to grow less quickly, that turning point, that's where the bottom is likely to be. And it turned out to be an accurate way to call the bottom. And so their narrative was correct, though I do wonder if in part that was because some very large investors decided to step in once their own narrative was proven true, and that provided enough confidence to other investors for the bounce to occur. And then while the bounce was occurring, additional narratives could kick in, like, oh, the case count is significantly dropping now. So there's interesting patterns, both in the underreaction and then the overreaction and how we catch the bottom and then the rebound. And you can see this in the data. So when we plot this out, we do have an icon app where on the Refinitiv Icon platform where you can see this chart and other charts of sentiment relative to various asset prices. Really all the assets that are tradable. And so you can see here two moving averages of sentiment relative to the yellow line, which is the S&P 500. And this is plotted since 2018. So you can see the coronavirus sell-off here in March and February. And you can see that sentiment was really quite positive, but sentiment went negative before the sell-off. Now, this is one of our signals that I'll talk about, this idea that sentiment, when it diverges from price, it often tells us, especially when things have been going well, it warns us that it may be time for a risk-off correction. Not always true, though, as you can see in the chart, but sometimes it is. And it is more often than not. So that's one idea. The second idea that you could see in that chart as well, let me go back there for a moment, is that sometimes sentiment may be coincident with price. There may be a feedback loop with sentiment driving prices higher or sometimes lower. And this actually goes back to the oldest financial advice. This is from 1688, from the first book on financial markets by Joseph de la Vega in Amsterdam. And it was called Confusión de las Confusiones, literally in English, Confusion of the Confusions. And it is the first book on financial markets. And his advice in this section that was a dialogue between a merchant who wanted to become a share trader and a shareholder, the merchant says, in this chaos of opinions, what do I do? And the shareholder says, go in the direction of waves and don't fight against the current. Now, this is not advice that you would hear on CNBC, I presume. I mean, you probably hear everything on CNBC. It's a 24-hour type channel. But in general, you're not going to hear someone tell you to just do what everyone else does. Figure out what everyone else is thinking and just do that. That's not common advice. And yet when we look at thousands of stocks, that actually seems to be pretty useful advice. So what I'm showing here is quantitative research based on a decile spread. So a rotational model, cross-sectional rotation model, where we looked at the past month of sentiment scores, sentiment averages for US stocks, taking the top 5,000 US stocks, really the top 3,000 by market cap, but we rolled it forward since 2006. And so about 2,000 of those went away in that period. So we started with about 5,000 total stocks in our pool. And we look at the past 1 month of sentiment in the media. Those stocks that were the most positive on their average are in the bluish green lines, and the ones that were the most negative are in the red lines. And it turns out that those that were rated the most positive, if you track them, their price performance forward, starting the first day of the next month, on average, you see they outperform significantly the most negative stocks. And we found this via some help, some friends, at some other researchers, and then since 2018, we've been tracking this, and it continues to be a very nice spread. And even this year, it's gotten even better. So it's quite an interesting spread. It's also an interesting spread because we see it globally. We see the spread in every major global market, and we see it from one day out to 1 year. So there's, for all different types of holding periods or timelines, you can actually use sentiment to rank stocks quite well. Now, it is correlated with past price momentum, but when you control for past price momentum, it's still there and it's still quite significant. So that's not the whole explanation. So here's another version of that. This is anger. So as I said, we do multidimensional sentiment, and it turns out that when the public is angry at a company, companies, that share price tends to underperform. So what we did here was a different way of displaying that type of prior study. In this case, we only look at anger. We rank stocks by the prior month of anger, bin them into quintiles, 20% bins based on their rank. Those that had the highest anger are tracked here in the red line. Month after month, it's refreshed. And then here's in the blue line. So when public anger is targeted at a company in 1 month, the next month, it's likely to underperform. And we see that again and again over many years, and you can see it even creates a nice spread here. So public outrage is generally a bad thing. Although I have to say, at the extremes, we did find a different pattern there, but fundamentally, that's one. Now, I mentioned risk-off signaling when we talk about coronavirus, and this is actually a strategy used by one of our big clients and investment partners in the Netherlands. Talk about how they've created their own risk-off model with this data. And this is actually a quotation from them in 2016. I was on a podcast with them about 4 months ago, and they also report outperforming throughout the coronavirus correction because of, again, risk-off models and other strategies they use based on media sentiment flow. So they've been able to leverage this data quite successfully and have won performance awards and perform quite well in the funds that use this data. So risk-off signaling in the case of coronavirus, this is another look at the coronavirus sell-off from January or December through June. You can see fear starting to pop up in the media. This is just above average fear, so it's not even, 50% of days we would expect this. But there was a long period without fear, and fear starts to pop up and really gets heavy, of course, during the sell-off. And then we had this long string of time without fear. And what was interesting there is when we talk about rebounds, there was a study that was pointed out to me about a year ago that some researchers had found relief from incidental fear actually leads to exuberant risk-taking. So if we're very paralyzed in fear about something and concerned, once we're relieved of that fear, we take excessive risk. And I know it feels like COVID just goes on and on, but now the stock market is pricing in this relief already. It's assuming that we'll get relief from COVID and things will be better. Certainly the economy is likely to boom once we get a vaccine and the majority of the population is taking it. So we are likely to see a nice boom coming out of this as people go back to the dentist and go to the store more, restaurants, etc. But of course, it feels like it's a long time coming now that we're in the midst of it. So another interesting strategy is buying on fear. So I mentioned anger, that it was actually good to avoid companies that people are angry with. And yet at the same time, you'll hear the opposite from some of the wealthiest investors in history, like Munahisa Honma, who was said to be the wealthiest individual in the world at the time of his life. He was a rice arbitrager. And Warren Buffett, who is said to try to be greedy when others are fearful and fearful when others are greedy. So they're essentially saying that it's good to buy on fear, which is sort of the opposite of what I've been saying so far, that actually you want to avoid negative things and angry things and buy the assets where there's positivity and low anger. So what gives? Like how do we reconcile these? Well, it turns out that occasionally, periodically, you will see these extremes where there's a lot of attention on a very negative event or a very negative thing, and you will see the bounce like we saw with coronavirus. And you can see this consistently in some assets. Like here's, let me see, it's maybe two, yeah. We can see this in some assets. In this case, this is currencies, and this is the carry trade on steroids. So it's the carry trade enhanced with fear. So what we do here is in currencies, we're borrowing from currencies that have low interest rates, investing into currencies that have high interest rates. But in this case, we're also only buying into those currencies that have fear and high interest rates. So that is probably some concern by investors about the business climate in the country or political action in the country. But it turns out that these currencies actually rebound quite a bit. And so you have a much higher return in these currencies than if you were to go into lower fear currencies. So you want to buy where there's fear. This is a currency example, but again, we see this across the board in many different assets. But it tends to be at the extremes where there's a lot of media attention on the negative event, and then we do see a bounce. When it's low level of attention, we get the other effect where there's trending. And so you might say, well, that's complicated, and it is. But markets aren't simple, are they? So if they weren't complicated, then we'd all be just doing this quite easily. So is sentiment predictive? And, you know, I've been giving you these examples that look predictive, and it's easy to cherry pick those examples from my side. So where's the proof? Well, part of the proof is that we did run a hedge fund that did outperform, and every time that we've traded this, it has outperformed. And we've done it in a couple small accounts and still actually have some going right now that are doing quite well. But the challenge is, of course, that it's we're a data provider, we're not a money manager, so this is our main thing. So we've created models that are predictive. One we did with the StarMine team last year, and it's called the StarMine MarketPsych Media Sentiment Model. So StarMine is a brand that creates predictive financial models. They were acquired by Reuters over a decade ago, and now Refinitiv and StarMine release models that are intended to be predictive of stock prices. So we've added one to their suite of models based on sentiment, which is uncorrelated with other factors, traditional factors, value, momentum, fund of French, etc. So that's really the goal, is to have additional factors to explain markets. In this case, sentiment seems to be one of them. We provide 3 scores underlying it: equity scores, which are really sentiment about the price of the stock and its volatility. Then we have business scores, which are sentiment about the business operations, and management scores, which are sentiment about the quality of the management and management activities. And we find that each of these has its own predictive power. This year, management sentiment has been the most predictive, and actually equity sentiment has been less predictive. But nonetheless, all together combined, they create a nice predictive spread. So what I'm showing here is, with this model, what we're doing is ranking every US stock every day from 1 to 100 based on its media sentiment. And this score is intended to indicate whether it's likely to outperform or underperform over the next 30 days. So if the stock has a score of 100, then it's likely to outperform a stock that has a score of 1 on a given day. So it's a very simple score, updates daily. And those stocks that are ranked in the top decile, meaning from 90 to 100, this is their performance in the green line since 2006. And those that are ranked in the bottom from 1 to 10, this is their performance in the red line. Now, this includes in-sample and out-of-sample sets, and we can give you more information in our brochure and white papers, which describe the modeling in detail. But importantly, the model was finalized here, and you can see here the spread between the two in blue has continued to outperform. So it still has a Sharpe ratio of 1 and continues to do quite well. So this model not only worked in sample and out of sample, but in real life production. And so that's the key here. It does appear that sentiment does not only perform, but continues to perform. So let's talk a bit about some of the social narratives that may be driving markets going forward. We've seen many this year. It's hard to necessarily understand all of the social narratives, of course, that will emerge. For example, the Green New Deal and renewable energy is a narrative that has really been taking shape this year as well, and that may continue next year. But there's also some more controversial ones, and we'll get into that. One is social unrest. So what do you think about social unrest in 2021? This is a polling question. Do you think there will be increasing social unrest in 2021 and it'll continue to grow? Do you think social unrest will continue about the level of 2020 and it'll stay about the same? Or do you think we'll have less social unrest in 2021 than we did in 2020? Let's go ahead and put your answer there, and I will click forward in about 3 seconds. Okay, so about half of you say it'll decrease. Well over a third say it'll get worse and increase, and 12% stay the same. So social unrest has been a significant issue this year, and a lot of this hinges, of course, on the election outcome and how it's accepted or not accepted. And so we'll see. Social unrest certainly has been a narrative this year. Here's a plot from our data set of social unrest, our social unrest index in the United States in the red dashed line, and the level of trust in the United States in this green dashed line. So what we've seen globally, both around the Arab Spring, Hong Kong protests, and other protest movements around the world, is we see that before social unrest and violence takes off, we usually see a drop in social trust. And so we see a big decline in trust with the George Floyd killing, and then we see this rise in social unrest occurring as well, almost simultaneous with the publication, the publicizing of that video and the killing. And of course, with the social unrest, things have been going up. In this chart, this was through August. Now, social unrest rises when there is, of course, conflict. And conflict, in this case, has been encouraged not only by, say, foreign state actors and working in the United States on social media, but also by the structure of algorithms in social media themselves, which select on the controversial headlines that get clicks. So people tend to click on items that are extreme, whether it's extreme in their belief system or extreme against their belief system. And that's why we tend to see that people are not getting balanced news. If you get news in your feed, you're actually getting more customized news that is extreme, because people are clicking on extremes, including when they don't agree with it. They tend not to click on things that's balanced or boring, essentially. And that itself contributes to polarization. So another interesting thing to discuss is the social inequality in the media. Okay, so social inequality here in the yellow line since 2018, references to social inequality in the media versus the stock market, the S&P 500 is in the white dash line. We plotted the stock market because it's quite interesting. When the stock market drops, sometimes references to social inequality drop, and as the stock market rises, more and more people are talking about it because, of course, the group of Americans who own shares outright is getting wealthier, while those who don't own liquid assets is not. And so that's, of course, creating additional inequality. So inequality can and likely will in itself fuel more social unrest, depending on how it's handled by leadership. So social inequality is exacerbated by tax policies, et cetera, that lead to increasing social inequality, then certainly that will lead to more social unrest longer term. So given all of these themes, many of which have been very stressful this year and hopefully will we'll have some reconciliation going forward, how do you think things will go forward, at least with coronavirus? So this question is about coronavirus, and how long do you think it'll be until social and work life is feeling back to normal? That is, no distancing, full offices, no masks. Do you think it'll be the spring 2021, spring 2021, autumn or winter of 2021, not until 2022, or maybe we won't get back to this, how things were before at all? So go ahead and enter your answer there as to when you think life will get back to feeling normal. Part of the issue, of course, with the economic recovery is it hinges on this something going back to normal. And if there is no normal real life, then it'll have to be a virtual getting back to normal. Okay, so it looks like, yep, quite a few, the majority out of those four would say not until, we may not get back to the same normal at all. And definitely the majority would say not until 2022. So long-term disruptions we're looking at here. At least according to the wise audience. Of course, none of us knows entirely, but it's good to know each other's opinions and think about this, because this does, of course, determine much of how we plan for the future. Now, one other interesting slide here. We talked about inequality, social unrest. We also look at sentiment in the media, Main Street versus Wall Street sentiment. So that is articles and publications that are read largely by the general investor, or not, the just general business person and general citizen, versus those that are really about financial markets in the US. And when we look at, investment social media, investment news media is really quite positive, but everyone else has been quite negative. And that inequality there, that disparity is likely to come up in the future. Right now we see tech giants being targeted, but it may be that there will be more financial regulation, again, because of this disparity, or at least attempts at trying to reconcile this disparity politically. So the bottom line is, we know from quite a bit of research that media contributes to feedback loops. Usually these are momentum driven, that humans underreact to obscure, positive, or threatening information. That is, when something negative like COVID comes out, we don't react to it immediately or quickly enough. That sometimes bad news can culminate in emotional panics, which create overreactions or V-shaped bounces. And we know that the emotional trauma of crises and major dislocations like we've had, it lingers in us. It creates almost like a PTSD and changes behavior sometimes generationally. As you can see, as we discussed, many of us think to 36% that life won't get back to normal. And then the social consequences can include frayed trust, social unrest, and political movements against the elite. There's some great books like Why Nations Fail and The Narrow Corridor that talk about how political movements against the elite evolve. And if our democratic system remains with feedback, it's positive feedback feedback loops, then likely things will be ironed out. They'll just be different. We'll have different policies, different taxation systems. But if we don't have a democratic system that responds to social pressure, then we will have less, we'll have more social consequences to come. So it really depends on how responsive political parties are. And again, that in some ways depends on how responsive the information flow is. That is tech giants to the algorithms and how they display news to us. So there's a number of factors at play here, and a lot of them you're seeing right now in congressional hearings on tech giants, for example. So keep an eye on how this comes out. If the feedback loop works, as it usually does in democracy, things will be okay, and things should calm down. But again, sometimes things get more tense before the solutions are searched for. Good luck out there.
Richard, thank you. That was really interesting. We have a couple of questions that are in the chat, and I just want to encourage everyone to access more questions. Put your questions here. I know that we are working on a workshop. One of your senior researchers will be leading a workshop in November for our clients, right. And it's open actually to anyone who wants to attend. We'll be looking up close on how to work with the data. And speaking of that, we did get some questions early on when you were going through the presentation. We have one question on the sine waves that you had early on in the deck. What is the dominant frequency of these sine waves, and what determines its frequency in time? So if you could go back to that slide, or just
sure. So yeah, this is just a sort of an impressionistic representation, and we have looked at this data with wavelets, for example, and we haven't found a consistent frequency. Unfortunately, again, it's not simple. There's no consistent wave frequency in markets. This is just a general pattern. Let me find that. Oh yeah, there it is. Okay, so right, this is a more of a qualitative representation. There's no, with wavelets, we haven't found any consistent frequency yet. But good question. Yeah, I wish there were.
We have another question around distrust. Does distrust give you a leading signal?
No, unfortunately, well, it's a good question. So we've done different types of work with this data looking at different features. And for example, we did find with the S&P 500 that trust was quite a useful signal. using moving average crossovers, for example. That was historically, it was, I think, the most predictive signal, but it's really just it was just a simple study. We're just exploring. I would say with really reliable, robust results, no, we haven't seen trust emerge. We have seen with companies management trust be quite significant. And with countries, we have also seen that government corruption is a significant signal. So those have been significant, robust signals over time. But for this general trust index, we haven't seen it. It's got to be targeted to the leadership. And then we do see that as a useful signal. So good question.
We have another question here around what are the most significant keywords that you're seeing in building the index? So what are the most relevant keywords in building your sentiment index?
Right. So it really depends. We have a lot of puzzle pieces. So fear, for example, it turns out the most significant word is fear, right, in our fear index. With uncertainty, I mean, it's actually pretty straightforward, I think. We have some documentation on that, but most of the indexes are pretty much what you'd expect. Like our innovation index is words like innovative and cutting edge and bleeding edge, next generation, things like that. So each index has its own constituents, terms and such. And of course, on top of that, there's grammatical structures that we use, part of speech recognition, dependency parsing, to make sure that every word and term is being used in the correct way. There's a lot of ambiguous terms, of course, in finance and across fields. So we have to be very clear about what we're dealing with. So there's many other layers that go into this. So the terms are just a part of it, but we do have some documentation on that.
Several questions around the StarMine index that you mentioned, and so if you could just talk about it just a little bit more, just give people information. I know that it is available in Icon, yes, and it's available as a feed. Is that correct?
It's not available in Icon. It is available as a feed through QAC and FTP. And it's a 1 to 100 daily score for every U.S. stock. And actually, we have the global version is launching in a few weeks, 4 weeks. So it's a 1 to 1 daily score. It also has 3 subcomponent scores, which I alluded to. It has a equity score, a business score, and a management score. And these are based on themes. So, for example, the management score is based on references to trust in the management team, layoffs, innovation at the company, things that the management generally has control over or communication control over. And so we find that those have been quite useful, of course, this year. Then there's business references like to the accounting at the business, the earnings. That's another factor in sentiment that's also quite predictive, but in a different way than sentiment about the management team. And then thirdly is the equity. And when we combine them up, we use a basic machine learning model that's also used for behavioral analytics at Facebook and some other companies. And when we combine those together in this behavioral machine learning-based model, we do see good results in sample and out of sample, and then, of course, in the forward testing, as I demonstrated. Not just forward testing, but really live production. So that's a general idea with this model. And again, it covers U.S. stocks. What I'm showing here is U.S. stocks, but it also covers global stocks. And we see the same patterns, the same information flow characteristics seem to drive global stocks as well, whether you're in Japan, Australia, the Eurozone. It's quite significant. What you see here are the decile spreads. So the top 10%, so 400 or so stocks in the basket in the green line, 400 or so in the red line, and then the blue line between them is the difference, the spread between those 2 large deciles of stocks. And that's performance. Okay. We have actually, interestingly, so as I said, we have traded a little, like small portfolios. We ran a pilot portfolio on this that launched in January of this year. And what we do there is simply trade the top 10 stocks. We buy the top 10 stocks and short the bottom 10 stocks. And that's actually up 40% this year. No fees involved in that, but that simple dollar neutral account is up 40%. So it's done quite well this year.
There's a question here, Richard, about what we're seeing post-election as themes. And so this is getting into a little bit, like what themes are you looking at post-election COVID?
Well, I think, of course, it depends somewhat on who wins the election, and probably not so much maybe a little bit on who wins the Senate, but I think renewable energy is a huge theme. And this idea of the stimulus will, if it goes beyond the election, then if Biden wins, which the odds are now that Biden will win, we'll likely see a huge push into more renewables, solar, wind, et cetera. So I think those are important themes to keep track of. And then, in terms, I'm talking about themes that affect financial markets. Other themes will be related to democracy, court, Supreme Court, and electoral college. How will those be dealt with if there's a Democratic sweep? And we may see changes to our democracy and the way it functions, and that will be contentious and will lead to a lot of social unrest and violence. So that could be intense as well. So while, things will start out maybe accommodative if there's a Democratic sweep, I think things could get pretty ugly socially later in the year, depending on how priorities are tackled, especially related to the democratic system.
We have another question.
A lot of contingencies, I'm afraid. Depends on that. But that is generally how things go. It depends on which narrative takes over. And that narrative is determined by how events unfold.
We've been running an election series with Reuters, and there are a lot of opinions. And you really just have to kind of go through things and try to do some scenario analysis. But we have another question here. Again, it's about the StarMine MarketPsych model, right? So it says the performance of the line spread between deciles in 2020 is very impressive. Do you think this model is suitable in all regimes of the market?
That's a great question. So we actually designed it to be suitable in that when we did the modeling on it, in sample, of course, included 2008. And let me go back to here. So I showed you this equity sentiment as one of our scores. So when I showed you that spread, and I know I see the spread all the time, but you guys don't. So let me go back to it so you know what I'm talking about. This spread that I showed you with the sentiment score, this was really the inspiration for that StarMine model. And this is the foundation of our equity sentiment factor. This spread did well. As of now, it has done well this year, but not great. Like, it's done okay. Sentiment, and during the COVID crisis, it did terribly. So you're right. It is impressive that the sentiment model did well this year. And part of the reason is because it's not just sentiment about the stock or general sentiment. Most companies that sell sentiment data will give you general positive or negative sentiment. What we find is there's these sentiments that are more predictive in different regimes, like management sentiment does very well during a crisis because the strong leadership guides the company well through that crisis. Or business sentiment also does fairly well during a crisis because investors are talking about what aspects of the business are good. But general overall sentiment isn't that useful. So while it's good generally, this spread doesn't work well during a crisis. So that's a good question. Good question, yeah. We do see that different factors, and that's why we released 4 scores. So every day you get the 1 summary score and 3 subcomponent scores with this model, the StarMine model. So hopefully that answers the question.
Yeah, we have a number of questions about slides. The slides are available. They're available through the console. We'll also send it with the post-event follow-up. We have a survey, so please take the survey. Let us know what you think about this, what next you might hear from us, from Richard. Again, if you'd like to try the data or speak to us specifically, you have the data and you have a specific question about your instance, we'd love to be able to follow up with you. Just let us know. And we will follow up with you. Let me scan the Q&A just once more to see There's a funny question here, Richard, about your headset. Someone wants to know the brand.
That's hilarious. I was asking Karen before the talk. I said, should I wear this huge bulky headset or should I wear something else? Actually, I don't even know the brand. Should I? Oh, here. It says MPOW, MPOW. It's, I think, a Chinese brand on Amazon.
Okay. All right. Well, I mean, I think that is all that we have. If you have any specific questions, you can, again, just follow up with us. First dot last name at refinitiv.com. And Richard will get the questions over to you. We can also have our sales or customer success team help you specifically with anything you may have an issue with. If you want to try the data, let us know. Thank you for joining us today. And, we appreciate the time that you gave us, and hopefully you found this information valuable. So have a great day, everyone. Thank you.
Thanks, everyone. Good luck. Bye-bye.